If you're new to real estate investing and you're comparing real estate returns with other investment opportunities, it might not seem that impressive at first glance. You can get around 8% in annual returns if you invest in the S&P index passively, so even if you compare that with more typical 4% annual appreciation plus 4% in net rent yields on real estate, it's really not that exciting. But that's probably because you forgot to factor in the power of leverage. Real estate is the only asset class where you are able to get the most leverage possible and the lowest borrowing rates. And this allows you to multiply your success by 4 or 5-fold. Now, investing with leverage can significantly bump up your returns, but it is also higher risk. So in this video, I'm going to give you a better idea of how leverage works, how to use leverage safely, and finally, tips on how to get the most out of your leverage for real estate. If you like content like this, please give us a thumbs up and don't forget to subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. Successful leverage allows you to use other people's money to make more money, and it only makes sense if your expected returns are more than your borrowing cost. Plus, when you use less of your own money, you'll in turn be more leveraged, and being so gives you a higher expected rate of return. Here is a quick example based on a $1 million investment property that you can get in Toronto right now. Let's assume you pay for that property all in cash. So if you make 8% on the property's value per year, in 5 years' time compounded, you'll be up $470,000. In other words, your 5-year return on investment would be 47%. Now try that again, but this time instead we'll only pay for 20% of the price in cash and then pay for the rest of the 80% using a mortgage, which is typical of what our real estate investors are able to get. You still make 8% minus 2% in interest. So in 5 years' time compounded, with rough calculations, you'll end up with $338,000 of gain. Now, if you stack that against your $200,000 investment, your return on investment in this case would be 169%. Now, I simplified things a little bit here and didn't factor in closing costs or repair costs, but hopefully you get the main point that I was trying to convey, which is that leverage can knock your returns out of the park, and when that happens, your returns will definitely be better than the S&P index. As you know, higher risk translates to higher reward, but being more leveraged naturally means that your investment will get more risky, so it's just as important to use leverage correctly. We want to make sure we're safe and that we can afford our monthly expenses and mortgage each month so that we can actually hang on for the long term and reap those amazing returns after leverage. Now, to do this, of course, you can crunch exact numbers on an Excel spreadsheet, but if you want to do things on the fly, we have a quick, rough way to check that you're safe and you're not cash flowing negative each month. The formula is this: you take your cap rate and make sure it's at least 200 basis points, so 2% more than your mortgage interest rate. Now, if you don't know what cap rate is, I do have a video that talks all about it. In a nutshell, it's your net rent yield that you get by subtracting your annual operating expenses before your mortgage from your annual rents, and then dividing that by your property's value. And I'll try to explain our 200 basis point formula a little bit more. We're trying to make sure that we stay at least cash flow flat, so your net rents need to cover your interest, which we already have in our formula, and your principal pay down, represented by that 200 basis points. And we can fact check this by heading to a mortgage calculator. On a $1 million property with a 20% down payment, 30-year amortization, and a 2% interest rate, the annual principal pay down is around $20,000, so that's 2% of $1 million. Now, if we change the interest rate to 1.6%, the principal pay down is just over $20K, and that is still around 2%. Principal pay down gets lower with a higher interest rate, so at 3% interest, we're looking at around a $17,000 principal pay down. So even at that point, using 2% for principal pay down does provide enough buffer to make sure that our cash flows are safe. So if you do want to check cash flows on the spot, remember the 200 basis point rule. Sometimes people tell me that they also want to check that their real estate investment after leverage does perform better than just investing in the index. And I'd argue that it's really not necessary. Now, if you do agree with me, just skip over to the next section that I have marked. But if you do want to walk through the thought process with me, then keep following along. Essentially, we're checking that your appreciation plus your cap rate minus interest after leverage is more than 8%. And we just did another check just before with cap rates and interest rates, so we can use a little bit of algebra to simplify this formula. When we plug the first equation into the second equation, it gets simplified into this. As you can see, this formula got simplified because of the first check, and now cap rates and interest rates aren't variables anymore, and we're just left with comparing appreciation with leverage to make sure that we're doing better than the S&P. And basically, at 5 times leverage, annual appreciation just needs to be more than negative 0.4%. At 4 times leverage, appreciation just needs to be over 0. And even at 2 times leverage, meaning that we only put 50% cash in and 50% as a loan, annual appreciation would just need to be more than 2% to beat the S&P index. Now, this is a pretty low bar. Average annual inflation is already more than 2% per year, and we would never advise you to invest in things that go down in value in the long run. And because of this, that's why I think this check is not really necessary. Instead of meeting the bare minimum, let's flip the table around and talk about opportunities where we can maximize returns with leverage. And the first thing I'd recommend is to choose properties that has the best appreciation potential, because this gives you the biggest impact in my opinion. A 1% difference in annual appreciation might not seem like much, but in 10 years' time, that's a 10% difference. And then after you factor in 5 times leverage, that's actually a 50% difference in ROI. Let's compare that with if you were to invest in something else that had a 1% lower appreciation but 10% higher rents, which seems like a lot more. But 10% higher rents actually just translates to 0.5% more in cap rates or a 25% increase in ROI after leverage. In other words, the 1% higher appreciation opportunity is still the better investment. Now let's take a look at how long-term appreciation stacks up in Toronto versus nearby areas. Toronto's 10-year appreciation is 127%, Vaughan's is at 116%, Barrie is at 105%, Hamilton 101%, Oshawa 105%. So choosing to invest in Toronto wins hands down from an appreciation standpoint. Let's talk about the second thing to be mindful of. As you make your monthly payments, you're paying down your principal each month. So over time, you actually own more equity and you'll have a smaller loan. And this also means that your leverage will shrink over time. So once you have a bigger percentage of equity and you want to maximize your power of leverage, it's a good idea to refinance the property at market value so that you can pull more cash out to reinvest. And if you choose that route, we'd recommend going with a variable mortgage because they offer more flexibility and lower penalties compared to fixed rate mortgages. And here's the last thing to remember. Your total return is based on the difference between your expected return and your cost of borrowing magnified by leverage. So what this means is, of course, you'd want to maximize the difference at the start, but it will get even better if you can increase the difference over time, which will continue to help you generate even better returns. So the best scenario would be to buy when rents are on the rise, when property prices are expected to go up more quickly, combined with getting low interest rates. And all of these things are happening right now. At the moment in Toronto, we're consistently seeing housing supply shortages combined with growing demand as immigration resumes, so we expect stronger price growth ahead. On the rental front, Toronto rents have tanked over COVID and now it's on the rise quickly again as well, so that's another good sign. Finally, there's still uncertainty in the market, so they're keeping interest rates low. And all of these factors point to it being a great time to enter the Toronto real estate market. We're experts in investing in Toronto real estate, and if you want to help getting started, we're the best team to fill that role. We'll look at your requirements and your preferences and then match you up with the best investment property that fits your needs. After we help you buy it, we also provide renovations guidance, leasing, and property management if you need that as well. Just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.